If you are watching this, it means you know that saving your money in the bank will not make you rich. Now, you might be thinking of a clever solution to beating the market. If you put all your money in your personal savings account, you will earn around 0.5% annually. But if you put all your money and buy a stock account, you'll receive a 30 to 50% dividend annually. Investing in bank stocks can offer promising long-term opportunities. However, they may not be suitable for every investor. Bank stocks fall in the middle range of the risk-reward ratio. They can be vulnerable to economic downturns and are influenced by changes in interest rates, among other significant risk factors. It's important to note that the level of risk associated with bank stocks can vary significantly among different companies and countries. Therefore, investors need to understand how to evaluate and assess the risks involved when considering investments in bank stocks. If you want to know that you are the right investor for a bank stock, or if the bank stocks are worth investing in, make sure to watch until the end. All investments come with a risk, so before starting to invest your hard-earned money, it's very important to analyze the risk and reward ratio of the investment. Bank stocks possess certain rewards that can help counter the risks associated with investing in them. If you're planning to buy bank stocks, here are some rewards you'll get. First on the list is the bank's regulation. Few industries face as rigorous regulation as banking, particularly following the near collapse of the U.S. banking industry during the 2008-2009 financial crisis. Banks are now mandated to maintain minimum capital levels, and larger institutions undergo stress testing to assess their resilience in unfavorable conditions. These regulatory measures issued by the government lower the risk of bank stock investing. However, it's worth paying attention to that regulation can also introduce risks, especially for regional and local banks. If a bank becomes insolvent or appears to be heading in that direction, regulators can step in and take control. Second on the list is investment banking, which provides a range of financial services to corporations, governments, and other entities. Investment banks act as intermediaries between issuers of securities and investors who are seeking to purchase those securities. Banks engage in two types of business: commercial banking and investment banking. Commercial banking involves lending money and accepting deposits, and may include services like retirement planning and insurance products, while investment banking encompasses activities such as debt and equity underwriting, wealth management for high net worth clients, proprietary trading of stocks and bonds, and advising institutional clients on IPOs and mergers and acquisitions. From a risk perspective, commercial banking tends to fare poorly during recessions and turbulent markets, while investment banking tends to perform better. A great example is Goldman Sachs, a leading investment bank which experienced its second-best quarter ever in terms of revenue during the height of the COVID-19 pandemic in 2020. This implies that banks with diversified operations encompassing both commercial and investment banking can be comparatively lower risk in challenging economic conditions. Now that we've explored the world of bank stock investing and dived into the thrilling rewards that await confident investors, remember, no adventure is complete without acknowledging the exhilarating risks that come with it. So brace yourself as we uncover the intriguing risks involved in investing in bank stocks. Beneath the surface of the tempting world of bank stocks lie three threatening risks. These are seasonality, loan losses, and ever-watchful interest rate risk. Let's dive into each one and discover their impact. First on the list is seasonality. Banks move to the rhythm of the economy, making them vulnerable to the decline of the market and the flow of recessions. Imagine this. Banks thrive when consumers eagerly spend and borrow. However, recessions lower the volume of people wanting to buy cars, homes, and even swiping credit cards. And brace yourself, because during economic downturns, more consumers find themselves struggling to repay their debts, leading to dreaded loan losses for banks. However, it's worth noting that banks have fortified their defenses since the dark days of the past. Let's make JP Morgan Chase as an example. They stress-tested their resilience using more extreme scenarios than the Federal Reserve, and even in a hypothetical 35% GDP contraction and 14% unemployment, they emerged adequately capitalized with robust liquidity. Second on the list is the loan losses. When consumers and businesses are delayed in repaying their debts, banks bear the stress of the result. Banks are always prepared for some loan losses, even in prosperous times. However, when the storm of a recession strikes, loan losses surge as individuals and businesses struggle with their financial obligations. Third on the list is the percentage charged by banks on loans or earned on deposits and investments. Interest rates. It's the lifeline of the banks. The banking business can be a maze, with numerous revenue streams shaping their fate. But at its core, banks profit from a straightforward formula, which is accepting deposits, lending out money, and capitalizing on the interest rate differential. It's no surprise when interest rates skyrockets, it tends to sting bank profits. However, let's expose a common misconception. Falling interest rates do reduce bank profitability, but not to the extent you might assume. Let's consider Bank of America. From late 2018 to the end of 2021, as the federal funds rate dipped by 225 basis points, Bank of America's net interest yield fell by only 85 basis points, from 2.52% to 1.67%. While falling rates cast a shadow on bank profit margins, the relationship isn't a simple one-to-one equation. That's not the end of the risks associated with bank stocks. There's also another risk factor that should be considered carefully. As we sail through the complexity of bank stocks, we must also acknowledge the rising tide of disruption. Traditional branch-based banks face fierce competition from the financial technology industry, with online banks leveraging their cost structure advantage to offer tempting rates on deposits and more favorable loan terms. Moreover, an occasional storm of panic adds to the mix. History has shown that panics can send shockwaves through the financial system. Whether it be the crash of 1929 or the near collapse of the banking industry in 2008, panic has played a starring role. Take the recent collapse of SVB Financial's Silicon Valley Bank in 2023, where customers withdrew billions from the bank, causing a domino effect of fear and affecting other regional banking institutions. In the middle of the COVID-19 pandemic, bank stocks have become a subject of intrigue and curiosity. Let's take a simple dive into the world of bank stocks during these unprecedented times. We'll explore the impact of these stocks, the challenges they face, and the potential opportunities they have emerged amid this global crisis. Get ready for an exploration of the fascinating world of bank stocks in the COVID-19 pandemic. Assessing how bank stocks perform during tough market environments can provide valuable insights into their risk factors. The COVID-19 pandemic, similar to the 2008-2009 financial crisis, posed significant challenges for banks and exemplified previously discussed risk factors. The financial sector, including major banks, experienced a decline of 2% in 2020, in contrast to the 16% gain in the S&P 500. The Big Four banks, including JP Morgan Chase, Bank of America, Wells Fargo, and Citigroup, fared even worse. The economic downturn resulting from the pandemic not only led to a decrease in consumer loan demand, but also posed a significant risk as individuals faced income loss, increasing the likelihood of borrowers experiencing difficulties in repaying their debts. As we reflect on the performance of bank stocks during challenging market environments like the COVID-19 pandemic, how do you think the financial sector and major banks have fared in such times of crisis? Have you ever considered the impact of economic downturns on consumer loan demand and the ability of borrowers to repay their debts? Do you think that this might be the best time to buy bank stocks? Take a moment to ponder the potential risks and difficulties faced by banks and their customers during tough market conditions. To sum it up, bank stock investing presents a dual landscape of rewards and risks. On the reward side, investing in bank stocks offers the potential for steady dividends, capital appreciation, and exposure to the growth of the financial sector. Banks play a vital role in the economy, acting as intermediaries for lending and benefiting from various revenue streams. However, it's crucial to recognize the risks involved. Cyclicality poses a significant challenge, as banks are susceptible to economic downturns, leading to potential loan losses and decreased profitability. Interest rate fluctuations also impact bank stocks, with falling rates squeezing profit margins and rising rates introducing uncertainty. Moreover, the increasing disruption brought by fintech companies poses a threat to traditional branch-based banks. Online banks with their cost structure advantage can offer more attractive rates and terms, intensifying competition. Additionally, the occasional occurrence of panic can disrupt the financial system, triggering mass withdrawals and unsettling investor confidence. To navigate this complex landscape, investors must carefully assess the economic environment, monitor the risk management practices of banks, and stay informed about technological advancements. A balanced approach that combines risk management, adaptability, and a long-term perspective is essential. Always remember that bank stock investing can be rewarding, but not without its share of risks. By understanding and managing these risks effectively, investors like you can capitalize on the potential rewards while navigating the dynamic nature of the banking industry. Now, are you ready to take part in the bank stocks investment? If you have more ideas when it comes to bank stock investing, please leave your thoughts in the comments section below. And if you'd like to know more about investing, you might want to check this one. That's all for today. Have a good time investing.